Special Report: The growing challenge of underwater mortgages for American homeowners. The United States housing market has experienced significant fluctuations in recent years, influenced by economic policies, interest rates, and broader market dynamics. A recent report from Adam, a real estate data firm, highlights a worrying trend: the increase in the percentage of homes that are seriously underwater. This term refers to homes with outstanding loans at least 25% more than their market value. In the first quarter of 2024, 2.7% of homes nationwide fell into this category, up from 2.6% in the previous quarter. Although this figure remains lower than pre-pandemic levels, it raises concerns about the financial stability of homeowners and the broader housing market. The rise of underwater mortgages. During the pandemic, government stimulus and rising property prices significantly boosted homeowners' equity. However, the subsequent rise in interest rates, aimed at curbing inflation, has cooled the housing market. This cooling effect is now reflected in the slight increase in underwater mortgages. Mortgages can become seriously underwater when a home is purchased at an inflated price or with a small down payment, leaving little buffer if property values decline. For many homeowners, particularly those who bought recently, the combination of higher purchase prices and modest down payments has increased their vulnerability to market downturns. Regional disparities. The increase in underwater mortgages is not uniform across the country. Southern states have seen a more pronounced rise. For instance, Kentucky's share of seriously underwater homes jumped from 6.3% to 8.3% in just a few months. West Virginia, Oklahoma, and Arkansas also reported significant increases. Kentucky, in particular, leads the nation with a year-over-year increase of over 20,500 homes falling into the underwater category, nearly double the second-place state. Among metropolitan areas with populations exceeding 500,000, Baton Rouge, Louisiana, recorded the highest share of seriously underwater mortgages at 13.4%. New Orleans followed with 7.3%, and Jackson, Mississippi, and Little Rock, Arkansas, were also notably high at 6.5% and 6%, respectively. Interestingly, Syracuse, New York, also made the list with 5.6% of its homes underwater, showcasing that this issue isn't confined to the South. Implications for homeowners. For the average American homeowner, these statistics translate into significant financial stress. Being underwater on a mortgage limits options for refinancing and selling the property without incurring losses. It can also lead to increased financial strain, as homeowners may struggle to keep up with payments on a property worth less than the loan balance. Moreover, the psychological impact of negative equity cannot be understated. Homeownership has long been associated with financial security and personal investment. When the value of this investment drops, it can lead to feelings of insecurity and decreased consumer confidence, which further impacts the broader economy. The rise in underwater mortgages, though still below pre-pandemic levels, is a troubling sign for the U.S. housing market. It highlights the ongoing challenges faced by homeowners, particularly in regions experiencing higher rates of negative equity. As we look deeper into the next part of this report, we will explore the specific factors contributing to these trends and the broader economic implications. Contributing factors to the increase in underwater mortgages. Several factors have contributed to the recent rise in underwater mortgages, with economic policies, market dynamics, and regional disparities playing significant roles. Understanding these factors is crucial for comprehending the broader implications for the housing market and the economy. Higher interest rates and inflation. One of the primary drivers behind the increase in underwater mortgages is the rise in interest rates. In an effort to curb inflation, the Federal Reserve has raised interest rates multiple times over the past year. Higher interest rates have led to higher mortgage rates, which in turn have increased the cost of borrowing. This has cooled the housing market by reducing the affordability of homes, leading to slower price growth, or even declines in some areas. During the pandemic, low interest rates spurred a housing boom, with prices soaring as buyers took advantage of cheap financing. However, as interest rates climbed, the market began to cool. For homeowners who purchased at the peak of the market with minimal down payments, any subsequent decline in home values can quickly result in negative equity. Regional economic conditions. Economic conditions vary significantly across different regions, influencing local housing markets. In the southern states, where the increase in underwater mortgages has been most pronounced, several factors are at play. These regions often have economies heavily reliant on specific industries, such as energy, agriculture, and manufacturing, which can be more volatile and sensitive to broader economic shifts. For instance, states like Kentucky and West Virginia have economies tied to the energy sector, which has experienced significant volatility in recent years. Declines in these industries can lead to job losses and reduced economic activity, putting downward pressure on home values and increasing the likelihood of underwater mortgages. Housing market dynamics. The dynamics of the housing market itself also contribute to the increase in underwater mortgages. During the pandemic, limited housing inventory and strong demand led to fierce competition among buyers, driving prices up. Many buyers stretched their budgets, often making small down payments to secure homes quickly. As the market cools and prices stabilize or decline, these homeowners are left with properties worth less than their loan balances. Additionally, new homebuyers, who entered the market during this period, are more vulnerable to negative equity. Long-time homeowners have likely built up significant equity over the years, providing a cushion against market fluctuations. In contrast, new buyers, especially those with high loan-to-value ratios, are at greater risk of falling underwater. Regional hotspots of underwater mortgages. The rise in underwater mortgages is not evenly distributed across the country. As previously mentioned, southern states have seen a significant increase, with Kentucky, West Virginia, Oklahoma, and Arkansas experiencing some of the largest jumps. Baton Rouge, Louisiana, leads the metropolitan areas with the highest share of underwater mortgages at 13.4%. These regional hotspots are often characterized by economic volatility and higher rates of job losses, which can exacerbate the problem. For example, in Baton Rouge, the local economy's reliance on the energy sector has made it particularly susceptible to market downturns. Similar patterns are observed in other affected areas, where economic dependencies and housing market dynamics intersect to create higher rates of negative equity. The increase in underwater mortgages is a multifaceted issue influenced by rising interest rates, regional economic conditions, and housing market dynamics. Understanding these contributing factors is essential for addressing the challenges faced by homeowners and developing strategies to mitigate the impact. In the next part of this report, we will explore the broader economic implications and potential solutions for policymakers and homeowners. Broader economic implications. The rise in underwater mortgages, though currently modest compared to pre-pandemic levels, has significant implications for the broader economy. Negative equity not only affects individual homeowners but also has a ripple effect throughout the financial system and local economies. Impact on consumer spending. When homeowners find themselves underwater on their mortgages, their financial behavior often changes. Negative equity can limit their ability to refinance or sell their homes, tying up capital that might otherwise be used for consumption or investment. This reduction in financial flexibility can lead to decreased consumer spending, which is a critical component of economic growth. As homeowners cut back on spending to manage their mortgage payments, local businesses may also suffer from reduced patronage, leading to a slowdown in economic activity. Financial stability and lending practices. The increase in underwater mortgages also poses risks to financial stability. Banks and other lending institutions that hold these mortgages face greater exposure to defaults and losses. If a significant number of homeowners default on their loans, it can lead to financial strain for these institutions, potentially triggering broader financial instability. This scenario was a critical factor during the 2008 financial crisis when widespread mortgage defaults led to severe economic repercussions. In response, financial institutions might tighten lending standards, making it harder for potential buyers to obtain mortgages. This tightening can further cool the housing market, creating a cycle that perpetuates the problem of negative equity. Potential policy solutions. Addressing the issue of underwater mortgages requires a multi-pronged approach that involves both immediate relief for affected homeowners and long-term strategies to stabilize the housing market. Government intervention and relief programs. Government intervention can provide crucial support for homeowners struggling with underwater mortgages. Programs that offer mortgage refinancing options, principal reduction, or loan modifications can help reduce the burden on these homeowners. Such measures were implemented during the aftermath of the 2008 financial crisis and can be adapted to current conditions. Additionally, targeted relief programs for regions most affected by negative equity can help stabilize local economies. For example, economic development initiatives and job creation programs in states like Kentucky, West Virginia, and Louisiana can provide much-needed support to struggling communities. Strengthening financial regulations. Strengthening financial regulations to ensure responsible lending practices is another essential step. By preventing the issuance of high-risk mortgages and encouraging adequate down payments, policymakers can reduce the likelihood of homeowners becoming underwater in the future. Enhanced oversight of mortgage lending practices can also help identify and mitigate emerging risks before they become systemic problems. Promoting housing affordability. Promoting housing affordability is crucial for preventing future occurrences of underwater mortgages. Policies that increase the supply of affordable housing and provide financial assistance to first-time homebuyers can help ensure that more people can enter the housing market without overextending themselves financially. These measures can also help stabilize home prices and reduce the volatility that leads to negative equity. Conclusion and future outlook. The rise in underwater mortgages highlights the ongoing challenges within the U.S. housing market. While the current levels remain below pre-pandemic highs, the trend is concerning and warrants attention from policymakers, financial institutions, and homeowners alike. By understanding the contributing factors and implementing targeted solutions, it is possible to mitigate the impact and promote a more stable and resilient housing market. The road ahead requires concerted efforts to support homeowners, stabilize financial markets, and promote sustainable economic growth. As we move forward, it will be essential to monitor these trends closely and adapt policies to address the evolving landscape of the housing market. This has been another video by PB at Sales Hospitality on YouTube. Thank you for watching, and be sure to subscribe for more insights and analysis on the latest economic trends.